Money is more than numbers in a bank account. It is a reflection of our choices, emotions, and beliefs. Most people assume that financial success is about intelligence or technical knowledge, but in reality, it is primarily about behavior and psychology. The way people think about money is shaped by their experiences, upbringing, and mindset. Two people can make completely different financial choices, even when given the same information, because their perspectives on risk, reward, and security are unique. Understanding this is the foundation of making smarter financial decisions. Point 1 of the biggest misconceptions about money is that earning more automatically leads to wealth. Many people assume that if they could just increase their income, they would become rich. But the truth is, wealth is not about how much you earn, it's about how much you keep. History is full of examples of high-income earners who ended up broke because they spent everything they made, and in contrast, there are countless stories of people with modest incomes who accumulated great wealth simply by saving and investing consistently over time. The difference is financial behavior, not income level. This brings us to a crucial point. Saving money is not just about having extra cash, it's about giving yourself options and freedom. Many people see saving as a sacrifice, but in reality, it is an investment in flexibility. Money saved is time earned, the ability to make choices without financial stress. It allows people to pursue opportunities, take risks, or even walk away from situations that don't serve them. True wealth is not about flashy possessions, it's about the freedom to live life on your terms. But why do so many people struggle to build wealth? One reason is human nature and our tendency toward short-term thinking. The brain is wired to seek immediate rewards. When people receive money, they often feel the urge to spend it on things that bring instant gratification, a new car, an expensive vacation, or the latest technology. These purchases may bring temporary happiness, but they do not build long-term financial security. The key to wealth is resisting the impulse for immediate rewards and instead focusing on compounding growth over time. Compounding is one of the most powerful forces in finance, yet many people underestimate it. The concept is simple: small financial decisions, repeated consistently over many years, lead to massive results. Many people believe that getting rich requires big risks or dramatic actions, but the reality is that slow and steady wins the race. Even small amounts of money, when invested wisely and left to grow, can turn into substantial wealth over time. Patience is the secret weapon of the wealthy. In a world obsessed with quick success and overnight riches, the most successful investors understand that time in the market is more important than time in the market. Many people make the mistake of jumping in and out of investments, trying to predict the perfect moment to buy or sell. But those who simply stay invested, riding out their ups and downs, tend to build more wealth in the long run. The greatest financial rewards go to those who stay patient and allow compounding to work in their favor. Another common financial mistake is lifestyle inflation. When people earn more, they tend to spend more. A raise at work often leads to buying a bigger house, upgrading to a luxury car, or spending more on entertainment. While there's nothing wrong with enjoying financial success, the danger comes when spending rises as fast as, or even faster than, income. This leaves people stuck in a cycle where no matter how much they earn, they never feel financially secure. The secret to escaping this cycle is simple: live below your means, even as your income grows. Point 1 of the most underrated financial skills is humility. Many people assume that they must take big risks or chase high returns to get ahead. But in reality, avoiding financial mistakes is often more important than making brilliant investments. Playing defense, protecting what you already have, is just as important as playing offense. Smart investors know that preserving wealth is key to long-term success. They avoid reckless decisions, they stay diversified, and they always prepare for the unexpected. And that's another important lesson: expect the unexpected. Many people assume that financial success follows a predictable path, but the truth is, life is full of surprises. Economies rise and fall. Markets crash. Jobs disappear. Unexpected expenses arise. The people who thrive financially are the ones who prepare for uncertainty. They don't assume that things will always go according to plan. Instead, they build financial buffers, emergency funds, diverse investments, and a mindset that embraces adaptability. Luck and risk play a bigger role in financial success than most people realize. Many people assume that the wealthy got there purely through hard work, but luck often plays a huge role. Being born in the right place, at the right time, or having access to the right opportunities can make a significant difference. However, just as luck can work in one's favor, risk is always present too. Even the best financial plans can be disrupted by unexpected events. This is why humility is crucial. Never assume that success is entirely due to skill, and never assume failure is entirely due to bad luck. Greed is another major obstacle to financial stability. Many people fail to recognize when enough is enough. They keep pushing for more, bigger deals, higher returns, more possessions, without realizing that chasing endless wealth often leads to poor decisions. Some of the greatest financial collapses in history have been caused by people who already had enough but took excessive risks because they wanted more. True financial wisdom comes from knowing when to stop, when to protect what you have, and when to shift from growth to stability. Another key principle is staying rational under pressure. Financial markets, business cycles, and even personal finances are full of emotional highs and lows. Many people make bad decisions because they let emotions drive their choices. Fear leads to panic selling in market downturns. Greed leads to reckless speculation in booms. The most successful investors and savers develop the ability to stay calm, think long-term, and not let short-term emotions dictate their financial moves. At its core, financial success is not about knowing everything about investing, economic trends, or financial strategies. It's about mastering your own behavior. People don't fail financially because they lack knowledge, they fail because they struggle with discipline, patience, and emotional control. Money management is more about mindset than math. Ultimately, the most powerful lesson of the psychology of money is this: true wealth is freedom. It's not about having millions in the bank, it's about having control over your time, choices, and future. People who understand this focus on building security, maintaining stability, and creating a life that aligns with their values, rather than endlessly chasing bigger numbers. Wealth is built not through sudden windfalls but through small, repeated decisions over time. The challenge is that people often misunderstand what wealth truly is. Many equate wealth with material possessions, luxury cars, big houses, designer brands, but these are merely displays of wealth, not indicators of financial security. The truth is, real wealth is often invisible. It is the money that isn't spent. It is the financial cushion that allows a person to make life choices without stress. People who truly understand money recognize that wealth is not about how much you earn, but how much you keep and how long you let it grow. The most financially successful individuals often have one thing in common: they live below their means. This doesn't mean deprivation, it means having the discipline to avoid lifestyle inflation, the patience to allow investments to compound, and the wisdom to understand that financial freedom is more valuable than any purchase. But the biggest barrier to wealth is human psychology itself. People make financial decisions based on emotions, biases, and past experiences rather than logic. Fear, greed, overconfidence, and impatience drive decisions that often lead to financial regret. The ability to control these emotions is what separates those who build lasting wealth from those who struggle. One of the greatest examples of this is the stock market. People often assume that investing is purely about numbers and strategies, but in reality, it is about behavior. The most successful investors are not the ones who constantly chase high returns but those who simply stay invested for long periods. The biggest enemy of investment success is not market downturns, it is the investor's own emotions. When the market drops, fear takes over, and many sell at a loss. When the market rises, greed takes over, and many overextend themselves. The key to long-term financial success is not reacting emotionally but staying the course and letting time do the work. Compounding is the magic ingredient that turns small investments into massive fortunes, yet many people underestimate it because it works slowly at first. The reason many fail to take full advantage of compounding is that they expect immediate results. They invest a little, see small gains, and assume it's not worth it. But true wealth is built over decades, not days. The earlier one starts and the longer one stays invested, the greater the rewards. One of the most important traits in financial success is having a long-term perspective. Many people get caught up in short-term fluctuations, worrying about temporary losses, trying to predict market movements, or reacting to the latest financial news. But the wealthiest individuals understand that short-term noise is irrelevant in the grand scheme of things. The market has always had ups and downs, but over time, it has consistently grown. The lesson here is simple: stay invested, be patient, and let time work in your favor. However, financial success isn't just about investing. It's also about how you manage risk. Many people fail financially not because they didn't make money, but because they lost too much when things went wrong. Risk is always present in financial decisions, and ignoring it can be disastrous. The best way to handle risk is to be prepared. Always expect the unexpected. This means having emergency savings, diversifying investments, and never betting everything on one opportunity. History has shown that even the most successful people face financial setbacks. No one is immune to bad luck, economic downturns, or unexpected crises. The difference between those who recover and those who don't is how they prepared before things went wrong. Having financial buffers, cash savings, diversified investments, and a mindset that embraces uncertainty can make all the difference in surviving tough times. Another critical aspect of financial success is understanding the role of luck and timing. Many people assume that success is purely a result of skill, but luck plays a much larger role than most realize. Being born in the right place, at the right time, or having access to the right opportunities can make a significant difference. However, just as luck can work in one's favor, it can also work against them. This is why humility is crucial. Never assume that financial success is entirely due to skill, and never assume financial failure is entirely due to bad luck. One of the biggest traps in finance is comparing yourself to others. Many people feel pressure to keep up with friends, family, or society's expectations. They see others buying new cars, upgrading homes, or posting lavish vacations on social media, and they feel the urge to do the same. But the reality is that most people's financial situations are not what they appear to be. Many individuals who appear wealthy are actually drowning in debt, living paycheck to paycheck, or one crisis away from financial disaster. The key to financial security is focusing on your own goals, not competing with others. True wealth is not about having the most, it's about having enough. The happiest and most financially secure people understand that contentment is more valuable than accumulation. Many people spend their lives chasing higher incomes, bigger homes, and more possessions, thinking it will bring happiness. But research has shown that after a certain point, more money does not lead to more happiness. What does lead to happiness is control over one's time, freedom from financial stress, and the ability to make choices without money dictating every decision. Another important lesson in financial success is avoiding overconfidence. Many people believe they can predict market movements, make perfect investment decisions, or take big risks without consequences. But history has proven that even the smartest financial experts get things wrong. The truth is, no one can predict the future with certainty. The key to long-term success is not trying to be the smartest person in the room, it is acknowledging what you don't know, preparing for different scenarios, and making conservative financial choices. Ultimately, the psychology of money teaches that financial success is about behavior, not intelligence. It's not about having the highest income, the best investment strategy, or the most financial knowledge. It's about being disciplined, patient, and emotionally resilient. The people who build and maintain wealth are not always the ones who make the most money, they are the ones who make smart financial decisions consistently over time, and the most important financial decision of all: defining what money means to you. Many people chase wealth without understanding why they want it. Some seek security, others want freedom, and some want to leave a legacy. The most successful individuals have a clear understanding of what they want money to do for them, and they align their financial decisions with those values. One of the biggest financial mistakes people make is assuming that once they have more money, their financial problems will disappear. But the reality is that money does not change financial habits, it amplifies them. If a person struggles with saving when they earn a small income, they will likely struggle even when they earn a large income. If someone spends recklessly with little money, they will spend recklessly with a fortune. Money magnifies behavior, it does not fix it. This is why so many lottery winners and high-income earners end up broke. It's not because they didn't earn enough, it's because they never developed the habits of managing money wisely. The true key to financial security is not how much you earn, but how well you manage what you have. A crucial part of managing money wisely is understanding your personal relationship with risk. Everyone has a different tolerance for financial uncertainty. Some people are comfortable taking big risks in the hope of big rewards, while others prefer slow and steady growth. The problem arises when people try to copy someone else's strategy without considering their own risk tolerance. What works for one person may not work for another. For example, an aggressive investor might pour money into volatile stocks, seeking high returns. But if a person with a lower risk tolerance follows the same strategy, they might panic during market downturns and sell at the worst possible time. The best financial decisions are not necessarily the ones with the highest potential returns, they are the ones that allow a person to sleep peacefully at night. Understanding personal risk tolerance also applies to career choices. Many people assume that financial success only comes from taking big risks, quitting a stable job to start a business, investing in risky assets, or making bold financial moves. But financial success can also come from consistency, patience, and avoiding unnecessary risks. Sometimes, the smartest decision is not making a risky move at all. This is where the power of optionality comes into play. The most financially secure individuals are those who give themselves choices. They don't lock themselves into rigid financial situations that limit their freedom. They build emergency funds, create multiple streams of income, and avoid debt traps that could leave them financially stuck. Having options means having the ability to walk away from bad deals, take advantage of opportunities, and adapt to changing circumstances. One of the greatest advantages a person can have in finance is flexibility. Many people believe wealth is about having more money, but in reality, it's about having more control over your time and decisions. A person with a modest income and no debt may have more financial freedom than someone with a high income and heavy financial obligations. True wealth is not just about numbers, it's about how much freedom a person has to live life on their own terms. But the paradox of financial success is that the more successful a person becomes, the harder it is to maintain that success. As wealth grows, so do expectations, responsibilities, and risks. Many people fall into the trap of assuming that just because they have achieved financial success, they are immune to failure. This is why some of the wealthiest individuals eventually lose everything. They stop being cautious, take bigger risks, and assume that past success guarantees future results. The best way to maintain financial success is to stay humble and keep learning. The moment a person believes they have mastered money is the moment they become vulnerable to financial mistakes. Markets change, economies shift, and unexpected events happen. The ability to adapt, stay informed, and make thoughtful financial decisions is what separates those who maintain wealth from those who lose it. Another major challenge in financial success is avoiding lifestyle inflation. Many people assume that as their income increases, their happiness will increase too. But what often happens is that as they earn more, they spend more. A person who once lived comfortably on a modest salary suddenly finds themselves feeling financially stretched, even with a higher income, because they increase their expenses just as fast as their earnings. This is why some people who earn millions still live paycheck to paycheck. The cycle of wanting more, spending more, and feeling financially stuck never ends unless a person consciously breaks it. The key to escaping this trap is defining what enough means. People who are truly financially secure understand that more money is not the goal. Financial peace of mind is point. One of the most powerful concepts in financial success is the ability to delay gratification. Many of the best financial decisions don't provide immediate rewards, they pay off years or even decades later. The discipline to invest money instead of spending it, to wait instead of rushing into a financial decision, and to build long-term wealth instead of seeking quick gains is what sets apart those who achieve lasting financial success. Compounding wealth is not just about money, it's also about compounding knowledge, experience, and good financial habits. Small decisions made consistently over time create massive results. A person who starts saving and investing early, even in small amounts, will likely end up far wealthier than someone who earns more but waits too long to take action. The earlier good financial habits are developed, the greater the rewards. But perhaps the most important lesson in the psychology of money is this: no amount of financial success matters if a person is not happy with their life. Many people chase wealth believing it will bring them happiness, only to find themselves stressed, overworked, and constantly worried about maintaining their financial status. True wealth is about more than just money, it's about having a life that feels fulfilling, meaningful, and free from financial stress. Money should be a tool that enables people to live the life they want, not a source of constant anxiety. The most financially successful individuals are not necessarily those with the highest net worth, they are those who have found a balance between financial security and personal fulfillment. One of the most underrated skills in personal finance is the ability to keep the money you've earned. Many people focus only on how to make more money but fail to understand that getting rich and staying rich are two completely different skills. Making money requires taking some level of risk, optimism, and hard work. But keeping money requires humility, discipline, and an understanding of when to stop chasing more. History is full of examples of people who built massive wealth only to lose it all. This isn't because they were unlucky, it's because they took too many unnecessary risks, ignored financial fundamentals, or let greed override logic. They assumed that past success guaranteed future success and failed to recognize the fragile nature of financial stability. The key to preserving wealth is learning to balance offense and defense. Offense is about making smart financial moves to grow wealth, investing, taking calculated risks, and pursuing financial opportunities. Defense is about protecting that wealth by avoiding unnecessary risks, managing debt wisely, and preparing for the unexpected. Those who succeed in the long run understand that financial security isn't just about how much they gain, it's also about how much they avoid losing. One of the biggest threats to financial success is overconfidence. Many people assume that because they've made smart money decisions in the past, they will continue making them in the future. But financial markets, economies, and personal circumstances are constantly changing. What worked before may not work again. The most successful people in finance are not those who believe they always know the answers, it's those who are willing to adapt, stay humble, and continuously learn. Another major mistake people make with money is underestimating the impact of small financial decisions. Many believe that only big financial moves, like buying a house, investing in the stock market, or starting a business, determine their financial future. But in reality, it's the small, consistent habits that have the greatest long-term impact. A person who saves just a small percentage of their income each month, avoids unnecessary debt, and invests consistently will likely end up wealthier than someone who makes sporadic large financial moves but lacks discipline. Financial success is not about making one perfect decision, it's about making a series of small, smart choices over time. This is why compounding wealth is one of the most powerful forces in finance. Compounding is not just about money growing exponentially, it's about time magnifying small financial behaviors into massive results. A person who starts saving early and invests consistently, even with a modest income, can build significant wealth over decades. On the other hand, someone who delays saving, spends impulsively, or waits for the perfect financial moment may struggle to build wealth, even with a high income. But there's another side to compounding that many people overlook: compounding financial mistakes. Just as good habits build wealth over time, bad habits destroy it. A person who frequently makes impulsive purchases, takes on unnecessary debt, or ignores financial planning may find themselves trapped in a cycle of financial stress. Small mistakes, repeated over time, can lead to big financial problems. One of the best ways to avoid financial mistakes is to recognize emotional biases in money decisions. People often assume they make rational financial choices, but in reality, emotions like fear, greed, impatience, and overconfidence influence many decisions. For example, when the stock market crashes, many investors panic and sell at a loss, only to regret it later when prices recover. On the other hand, when the market is booming, people often chase quick profits, ignoring risks and overpaying for investments. In both cases, emotions drive decisions that hurt long-term financial health. The best investors and financially successful individuals train themselves to detach emotions from money decisions. They develop a mindset of patience, logic, and long-term thinking. Instead of reacting to short-term events, they focus on big-picture financial goals and avoid making decisions based on temporary emotions. Another common financial trap is comparing one's financial situation to others. In today's world, social media and modern consumer culture create unrealistic expectations about wealth. People see luxury lifestyles, expensive cars, and lavish vacations and assume that's what financial success looks like. But what they don't see is how much debt, financial stress, or insecurity might be behind those lifestyles. Many people go broke trying to look rich. They spend money to impress others, rather than building real financial security. The key to long-term success is defining personal financial goals, rather than chasing external validation. True wealth isn't about how much money someone appears to have, it's about having the freedom, security, and peace of mind that financial stability provides. This is why living below one's means is one of the most powerful financial habits. Many of the wealthiest and most financially stable people are not those who spend extravagantly, they are those who are disciplined about their spending. They avoid unnecessary expenses, save consistently, and invest wisely. One of the greatest financial lessons is understanding the difference between needs and wants. Many people convince themselves that luxuries are necessities, which leads to overspending and financial stress. A person who learns to distinguish between what they truly need and what they simply desire gains a massive financial advantage. The goal of financial success should not be to accumulate more possessions, it should be to create a life with options, flexibility, and freedom. Money should be a tool to support a fulfilling life, not something that causes constant worry and pressure. Many people assume that achieving financial security requires making extreme sacrifices, giving up all pleasures, working endlessly, or avoiding spending altogether. But in reality, financial success is about balance. It's about spending wisely, saving consistently, investing patiently, and understanding that money is a tool for freedom, not a source of stress. Perhaps the most important lesson of all is that money is deeply personal. What works for one person may not work for another. Financial decisions should be based on personal goals, risk tolerance, and life priorities, not what others are doing. The most successful people in finance understand that there is no single, right, way to manage money, only the way that aligns with their values and long-term vision. One of the most misunderstood aspects of wealth is the concept of financial independence. Many people assume that being financially successful means being able to afford luxury cars, big houses, and extravagant vacations. But true financial independence is not about what someone can buy, it's about the ability to make life choices without being constrained by money. Financial independence means having the ability to walk away from a bad job, take a break when needed, or pursue opportunities without constant financial stress. It provides freedom, security, and control over one's time. The wealthiest people are not necessarily those with the highest income, but those with the most control over how they spend their time. This is why saving money is often more powerful than simply earning more. Many people chase higher salaries, thinking it will solve their financial problems, but they continue increasing their spending along with their income. No matter how much they earn, they feel trapped in a cycle of work and expenses. In contrast, someone with a modest income but disciplined saving habits can achieve financial independence much faster. One of the most overlooked benefits of saving is the flexibility it provides. Life is unpredictable, and having financial reserves gives people the ability to handle unexpected situations without stress. A person with savings can survive job loss, medical emergencies, or sudden expenses without falling into debt or panic. Money saved is time and stress avoided in the future, but many people struggle to save because they assume they must have a strict budget or deny themselves all pleasures. In reality, saving is not about restriction, it's about freedom. It's about choosing to prioritize long-term financial security over short-term desires. People who save consistently don't necessarily live in deprivation, they simply make conscious choices about what matters most. Another critical lesson in personal finance is avoiding the trap of over-optimization. Many people obsess over getting the perfect financial strategy, trying to time the stock market, find the best investment, or optimize every decision to the smallest detail. But in reality, perfection is impossible in finance. Markets are unpredictable, and no one can consistently predict the best investment strategy. Instead of chasing perfection, successful investors focus on consistency, patience, and avoiding big mistakes. They don't get caught up in the noise of daily financial news or short-term market movements. Instead, they stick to simple, time-tested financial principles: spend less than you earn, invest consistently, and avoid emotional decisions. A major reason why many people struggle with money is that they treat personal finance as a purely mathematical problem. They assume that as long as they follow the right financial formulas, they will be successful. But personal finance is more about behavior than numbers. Even the smartest financial plan will fail if emotions, impulsive decisions, or bad habits get in the way. Many people know they should save money, avoid debt, and invest wisely, but they struggle to follow through because their emotions override logic. This is why mastering money is less about intelligence and more about self-discipline, patience, and emotional control. One of the most powerful financial habits is learning to delay gratification. People who can resist the temptation of immediate pleasure for greater future rewards often end up wealthier and more successful. The ability to wait, be patient, and think long-term is one of the greatest advantages in finance. This is why avoiding lifestyle inflation is crucial. Many people assume that as they earn more money, they should upgrade their lifestyle, buying bigger houses, newer cars, and more expensive luxuries. But this often leads to the same financial stress, just at a higher income level. True financial success comes from keeping expenses under control, even as income grows. A person who maintains a simple lifestyle, saves a high percentage of their income, and invests wisely will achieve financial independence far faster than someone who constantly upgrades their lifestyle. Many people assume that financial security requires extreme frugality, cutting every possible expense and living in deprivation. But in reality, moderation is key. The most successful people in finance find a balance between enjoying life today and preparing for the future. They understand that money should be a tool for freedom, not a source of constant stress. This is why avoiding unnecessary financial stress is just as important as earning money. Many people push themselves to extreme levels, working endlessly, stressing over investments, and obsessing over every financial decision. But money should bring peace of mind, not anxiety. The goal of financial success is not just to accumulate wealth, but to create a life that feels fulfilling, secure, and enjoyable. One of the most underrated financial skills is knowing when enough is enough. Many people assume that the goal of wealth is to keep accumulating more money, more assets, more success. But those who chase endless financial goals often find themselves trapped in a cycle of never feeling satisfied. They always want more, thinking that the next milestone will finally bring happiness, but real financial freedom comes from knowing when to stop chasing and start enjoying. It's about recognizing that security, freedom, and peace of mind are more valuable than simply having more money. Perhaps the greatest financial wisdom is understanding that money itself is never the ultimate goal. It is simply a tool to create the kind of life that feels meaningful and fulfilling. True wealth is not just about financial numbers, it's about having control over one's time, the freedom to make choices, and the peace of mind that comes from financial security. One of the most dangerous traps in finance is underestimating risk. Many people believe that as long as they follow the right strategies, their financial success is guaranteed. But in reality, risk is always present, no matter how smart or experienced someone is. The stock market, real estate, business ventures, every financial decision involves some level of uncertainty. The mistake many people make is assuming they can predict the future. They believe they can avoid losses, time the market perfectly, or always make the right moves. But history has shown that even the most brilliant investors, economists, and financial experts have been wrong at times. This is why humility is one of the most important financial traits. People who assume they know everything about money often make the biggest mistakes. They take reckless risks, ignore warning signs, and fail to prepare for downturns. In contrast, those who accept that they cannot predict the future make smarter, more cautious decisions. A key lesson in financial success is always planning for the worst, even while hoping for the best. The best investors and financial planners don't assume everything will go smoothly. Instead, they build safety nets, diversify their investments, and prepare for unexpected events. One of the biggest factors in financial outcomes is luck. Many people assume that wealth is purely the result of hard work and intelligence. But while effort and skill matter, luck plays a far bigger role than most people realize. There are countless stories of brilliant, hard-working people who made all the right decisions, but still ended up failing due to circumstances beyond their control. Economic downturns, unexpected market crashes, political changes, many external factors can impact financial success. At the same time, many people who achieve massive wealth were simply in the right place at the right time. They may have taken risks that paid off, not because of superior intelligence, but because of favorable circumstances. This is not to say that success is purely about luck, but rather, that acknowledging the role of luck keeps people humble. It prevents arrogance and overconfidence, helping individuals make better, more balanced financial decisions. The best way to approach money is with a mindset of gratitude and realism. Instead of assuming that success is guaranteed, or that failures are purely personal faults, people should understand that finance is a mix of skill, discipline, and luck. This perspective allows for better decision-making, lower stress, and a healthier relationship with money. Another key lesson in financial psychology is avoiding the trap of comparison. Many people measure their financial success by looking at others, friends, colleagues, social media influencers. They feel pressured to keep up, to buy expensive things, and to prove their wealth, but the truth is, most people who appear wealthy are not truly financially secure. Many live paycheck to paycheck, buried in debt, just to maintain an image of success. Real wealth is not about looking rich, it's about actually being financially secure. The people who build lasting financial success are those who focus on their own goals, rather than competing with others. They don't chase luxury for the sake of appearances. Instead, they make smart, patient financial choices that ensure long-term security and freedom. One of the most underrated financial skills is learning to say no. Many people struggle with money because they feel pressured to spend on social events, luxury purchases, or unnecessary upgrades. But successful people understand that saying no to short-term temptations is saying yes to long-term security. This is why building good financial habits matters more than chasing get-rich-quick schemes. Many people waste time looking for shortcuts, day trading, gambling, chasing high-risk investments. But the most reliable way to build wealth is boring, consistent habits, spending less than you earn, saving regularly, even if it's a small amount, investing for the long term, avoiding debt whenever possible, keeping emotions in check when making financial decisions. These simple habits, when followed consistently, lead to financial security over time. The key is patience. Many people give up on good financial habits because they don't see immediate results. But true wealth is built over decades, not days or months. Another crucial financial mindset is embracing uncertainty. No one knows what the future holds. Markets fluctuate, businesses rise and fall, and economic conditions change. Instead of trying to predict the future, the best approach is to build a financial plan that can survive uncertainty. This means having emergency savings, diversifying investments, avoiding unnecessary risks, and being flexible with financial goals. People who prepare for uncertainty don't panic when unexpected events happen, they stay calm and adapt. The core of financial success is understanding what truly matters in life. Money itself is not the goal. The real goal is freedom, security, and a life without unnecessary financial stress. People who focus purely on accumulating wealth often end up feeling empty and unsatisfied because they never define what they truly want from money. In contrast, those who have a clear vision, whether it's financial independence, early retirement, or simply peace of mind, make smarter, more fulfilling financial choices. They don't waste money on things that don't matter. They use money as a tool to create a life they truly enjoy. One of the most powerful mindsets in finance is understanding that enough is enough. Many people chase more money endlessly, thinking that the next financial milestone will finally make them happy. But true financial peace comes from knowing when to stop chasing and start appreciating. The wealthiest people are not those who have the most, but those who have enough. They understand that financial security, time freedom, and peace of mind are far more valuable than any luxury. In the end, the psychology of money is not just about numbers, it's about how we think, feel, and behave with money. It's about recognizing that wealth is not about luck or intelligence, it's about discipline, patience, humility, and wise decision-making. By mastering financial psychology, anyone can build a secure, fulfilling, and stress-free financial life, one where money serves as a tool for happiness rather than a source of constant worry.